Right now, a major indicator on the S&P 500 is sounding alarms. This isn't an automatic signal for a market crash, but ignoring it could be a risky oversight. Even if we're optimistic about the market, understanding the potential for low probability, high impact events is crucial. Over the past 18 months, we've done exceptionally well. We covered 9 stocks early on, including SMCI and Nvidia, and saw all of them go green, leading to a 130% gain. My personal portfolio, anchored by Tesla, Palantir, and the S&P 500, returned 160% in that time frame. But here's the catch. The S&P 500's price-to-earnings, PE, ratio is now around 27.5, the highest it's been in 2 decades. Historically, entering the S&P 500 at this level gives a 95% chance of underperformance over the next 3 years. This market rally has driven the S&P 500 to double the PE ratio of small-cap stocks on the Russell 2000, which are currently trading at a much lower 14 PE. Meanwhile, gold prices have spiked 33% since October 2023, a classic warning sign tied to potential market corrections. We can't dismiss these developments as anomalies. The market typically corrects itself, but for 18 months, we've seen no major pullbacks. The S&P 500, up 40%, and Nasdaq, up 70%, have surged without a 5% pullback since late 2022, defying historical patterns where 5% pullbacks happen 3 times a year. This kind of momentum without correction is rare and could mean a harsher pullback when it eventually comes. As investors, while we can't predict exactly when this will happen, we should prepare for all possible outcomes. For instance, in late 2022, I anticipated a rough year for stocks in 2023 but still continued investing. This approach of steady, regular investment, known as dollar-cost averaging, has paid off as we managed to achieve over 120% gains across 9 stocks. Similarly, by keeping an open stance, we can safeguard our investments against surprises, whether bullish or bearish. 2 possible paths are emerging. Either the S&P 500 cools down, creating a rotation into undervalued sectors, especially small caps, or we see a deeper market-wide correction. The S&P 500 has been stagnating while the Russell 2000 is up 10%, hinting at a potential rotation. Small caps, especially those on the Russell 2000, are set for growth if the Federal Reserve follows through on expected rate cuts. Unlike the S&P 500, which is mostly insulated with fixed rates, nearly half of Russell 2000 loans have floating rates, making them more sensitive to rate cuts. Right now, the setup seems favorable for small caps. They are trading at half the PE ratio of the S&P 500 and primarily generate revenue domestically, making them well-positioned to benefit from U.S. rate cuts. Historical data even suggests that the first Fed rate cut typically leads to a 26.6% increase for small caps over the next year. It's essential to recognize the difference in dynamics between the 2 markets. The S&P 500 is global, with around 35% of its revenue coming from outside the U.S., while small caps are much more U.S.-centric. If the Fed reduces rates, the Russell 2000 could see significant upside. With major AI developments fueling a new market cycle, we might also be in the early phases of a larger tech boom similar to what we saw in the late 1990s. Given these indicators, it's wise to make precautionary moves. Consider selling a third of your most profitable holdings if you're heavily invested and sitting on sizable gains. By doing this, you protect some capital if a correction occurs, while still remaining invested to benefit if the market rises further. Alternatively, consider dollar-cost averaging. By regularly investing a fixed amount into high-quality companies or the S&P 500, you position yourself for gains over time, regardless of market conditions. This strategy allows you to profit during recessions, market crashes, or bull runs without worrying about precise timing. So that's the strategy for now. Whether the market continues climbing or faces a correction, being prepared and consistently investing remains key. Stay informed, take action where needed, and I'll see you in the next video.